Alright, I wanted to answer this person's particular question over the euro dollar forex market 360-minute chart. And this person's question was about probabilities. How do you make the math work right here when you see, okay, this bear breakout, 2-bar bear breakout, common logic would tell you 60% chance we'll get a measured move down before we get up to here. Well, yes, that's true in general. However, look to the left. When you look to the left, what do you see? Here's what I see. I see this right here. See, breakouts within a trading range are still part of a trading range. And when you're at the bottom of a trading range, what usually happens? It usually fails. A good example would be, I'll show you real quick. Here's the 5-minute chart of the E-mini. Well, we rallied, we were starting to stall, and then we sold off sharply. And if you think, boy, we're going to get a strong second leg down, measure move down to here, well, think again. It's a trading range. Bad follow through, and guess what?
Certainly an okay swing buy.
So yeah, it's probably going to fail. Anyways, back to what you were talking about. Alright, so this person was asking, the problem is you have a 60, this person says that they have a 60% chance selling here, stop up here, measure move down here. However, what about the trader who waits and sells up here? And he sells a 50% pullback. Well, look, they wouldn't have been filled, but let's say hypothetically they were. Their probability is better. So what he's asking is, if a trader sold here, is it 60% right here when it pulls back 50%? Because now trader B, who sells 50%, is risking here to here to here. They're risking up here, entries here, target down here. So they're getting a 2-to-1. But trader A, who sold this close, isn't. Well, you have to remember to look to the left. Take a look at Al's second book over trading ranges. He'll talk about most of the time when you get a breakout, it's not, the best entry is not to just sell the market like this or buy the market when you get a breakout. The reason why is most breakouts are within a trading range and most breakouts fail. It's kind of like selling this. You see this huge bar right here and you think, oh my gosh, it's a strong bear bar. We're bound to get a measure move down. Well, look at the context. Yeah, it reversed all these bars, but what will the follow through look like? Well, it closed the gaps. Here, sure, we got a bear breakout. Sure, we got follow through, but look, it didn't even get to the prior lows. So traders who sell this close are going to be, if they do, they're going to be very quick to make decisions because they know it's not as strong as a breakout would normally be. It's kind of like, it's over here. Strong bull breakout. We erased all these bars over here. However, it's still probably going to be a leg within a trading range. Here we channeled down. Well, that's probably the start.
We're so close to that green line.
Yeah, this is still, when you look to the left, it's still within a trading range. So you have hopeful bulls buying, hoping for a measured move up. You have smart bears saying, yeah, it's still within a trading range, I'm going to look to sell. Well,
bears or breakout pullback.
So think about the math. You buy this.
Sometimes these low twos.
Okay, sorry about that. I had to pause the video and take care of something real quick. But anyways, where I'm getting at is you have to ask yourself risk reward. Very big bull bar in a trading range. Price has to break above all these to get to the measured move. You buy here, stop down here. 1-to-1 it's not 60%, especially when you see this trading range behavior. So bears are aware big bars trap hopeful traders into the creation of a trend. You've heard Al say this spiel. Everybody's hopeful. It's human nature to want to be hopeful, but that's very dangerous, especially in trading. And when you see this, bears see it, they want to sell. They may not sell here, but when they start to see this, they're just going to sell. And they know the probability is decent, we'll get down to here. So how does that relate to your trade? Well, whenever you're at the bottom of a trading range, it is not 60% like it seems. Until we break below here, guess what? The odds favor a reversal in a trading range. So when you see this, you think, yeah, it's a breakout. It's strong enough for a second leg down. Guess what? Here's your second leg down. It is not strong enough for more likely a measured move down. And that's what happens in a trading range. Trading ranges, they fall below obvious support and reverse up. So when you see this, you can't be thinking, oh my gosh, how is this happening? This is so unfair. We got a breakout. Well, guess what? We got a breakout here. It failed. We got a breakout here. It rallied up to the high. Bear breakout. And guess what? It just went sideways and turned down. Breakouts in a trading range and in a channel. Nobody's selling this close. Sure they are. They're selling, scaling, and scalping out. But most traders are selling pullbacks. So relate that to the E-mini currently in the past couple days. Bear breakout. Traders will sell for a scalp, but look what's happening. We're forming a bottom with today's open. Look over here. Bear breakout, we pulled back. Bears don't want to sell the bottom of a channel. Bear breakout, pulling back. Bear breakout, pulling back. Bears don't want to sell the bottom of a channel. So yes, with your trade, it's 60% that we will go a little more down, but that does not mean a measured move down. It is not a strong breakout because it is within a trading range. So you're correct. When you see a breakout, like here, you have to be suspect. Sure, we're probably going to get a measure. This is a decent breakout. We've been rallying up, probably going to get a second leg down, and we got a second leg down. Well, at this moment, yeah, we'll probably get a second leg. Here, probably get a second leg. Here, well, look to the left. It's trading range. Bear breakout, we'll probably get a second leg down, and it's possible this is the second leg down. Trading ranges get second legs. They form, breakouts get second legs, and that second leg is the start of a channel. This is the first start of the channel, and then price retraces to the top of the channel and forms a trading range, and then you're in breakout mode. This whole thing's in breakout mode. Here's a great example. So we had a breakout and an extremely deep pullback. So and most traders, you may be thinking, oh my gosh, strong breakout. You're right, strong breakout, but it's at the top of the trading range. So it's better to look to buy a pullback. So just like here, bear breakout, better to look to sell a pullback. And we got 3 pushes down, 1, 2, 3. But traders were waiting to sell the pullback. That's why we rallied up. Bull breakout to the high, better to wait to buy a pullback or to sell at the high of the trading range. And we pulled back really deep. And a lot of times it's better to wait for a convincing pullback. And we got to move down, pulled back, and a strong bear breakout, making traders think it's always in short, but it's not. It's just a deep pullback, and then we rally back up. This happened This actually happened in the E-mini on the 5th. Excuse me, on the 5-minute chart. This happened over here. Strong bull breakout. We got above this high, the day's high right here, but not above over here. And strong breakout. Look to the left. We're in a trading range. The odds are we're going to find sellers, so wait to buy a pullback, and you got to buy down here. Same thing over here. Here's a high to buy, but tight channel. Probably the first level fail, so probably better to wait for a breakout pullback. here's your pullback. So I hope this helps.